Minasan, konnichiwa, Zamurai Engineer desu. In this video, let us discuss the answers to the final review. So, we have two videos for the final review, part 1, part 2, and we will answer it in this part 3 of the review. Okay, so let's proceed one by one. We'll do all the numbers. Okay. So, question number 1. Ethics are the standards of conduct by which one's actions are judged right or wrong, honest or dishonest, fair or not fair. Because the answer is all of the above. Question 2. Combining the activities of two corporations would violate the economic entity assumption. Because a corporation is an independent entity, another corporation is another independent entity, so they have to be separated in terms of recording their transactions and activities. Okay. Question 3. A business organized as a separate legal entity under state law having ownership divided into shares of stock is a corporation, because proprietorship is single ownership. B, partnership is two or more ownership. Corporation is the one which divided its ownership into shares of stock. So it depends upon which individual or entity owns percentage of stocks. Okay, corporation is the answer. Question 4. Net income will result during a time period when revenues exceeds expenses. Revenues are those money that is coming in as a payment for the services offered by our company or for the merchandise offered by a company somebody bought from us. So those are the revenue. Those the money that we receive. Okay. Revenues. If that revenues exceeds our expenditure, then we have net income. Question 5. Which of the following financial statements is prepared as of a specific date? Balance sheet. Okay. Balance sheet is type of financial statement that describes the company's status at a specific date. How much is the company's asset? How much the company's liability? How much the company's ownership equity at a specific point in time? So the answer is balance sheet. Question 6. Presented below is selected information related to Flanagan Corporation December 31, 2019. Flanagan reports financial information monthly. So it has the following details, and we are required to determine the total assets of Flanagan. So total assets, so just take a look at the asset account. Which one are the asset accounts? Equipment, 10,000. Cash, 8,000. What are the other asset accounts? Accounts receivable, 9,000. And that's all. Those three are the asset accounts. If you take a look at it. So others are revenue accounts, others are liability accounts. So the asset accounts, total it, the answer is $27,000. So, question 7. Presented below is selected information related to Flanagan Corporation at December 31, 2019. Flanagan reports financial information monthly. So monthly, this is a monthly report. Of course, we have the following given. We are required to determine the net income that Flanagan reported for December. So net income. So if we are looking for net income, try to locate all the revenue accounts and expenses accounts. Expense accounts have to be subtracted to revenue account. So let's take a look. Which are the revenue account? Equipment is not, cash is not, so service revenue is a revenue account. So 36,000. And then look for the expense account. Rent expense, utilities expense, salaries and wages expense. So those are the expense. So total all the expense account, then subtract it from the revenue account. So that's how we do it. So what is the answer? So the revenue minus all the expenses, we have the total expenses. So if you subtract it, we have the net income. Question 8. Presented below is selected information related to Flanagan Corporation at December 31, 2019, and they are reporting monthly. Determine the stockholders' equity. Flanagan at December 31, 2019. So, if you look at stockholders' equity, you need the accounting equation. What is the accounting equation? Assets is equal to liabilities plus stockholders' equity. If you are solving for stockholders' equity, you have to subtract liabilities from assets. Okay? So, add all the asset accounts, then add all the liabilities accounts, then subtract the liabilities accounts from the asset accounts, then we will get the stockholders' equity. So, which are the asset accounts? Equipment, cash, and what else? Accounts receivable. Those are the assets. Which one are the liabilities accounts? Accounts payable. What else? Notes payable. So then we can get the stockholders' equity. So that is how we do it. So total assets, we already know 27,000. Then notes payable and accounts payable, then total, and then subtract. We have the stockholders' equity. Okay? So question 9. Debits increase assets and decrease liabilities. Okay, this is what we know about debit. Take a look at debits could have mean many things, but take a look at A. Increase both assets and liabilities. It doesn't. It does not. Okay, it does not. It increase assets and decrease liabilities. That is debit. B. So A is incorrect. B is decrease both assets and liabilities. That is also incorrect. A is incorrect. B is incorrect. And letter D. Decrease assets and decrease assets is not debit. So, of course, the answer is C, by the process of elimination. Question 10. Accounts that normally have debit balances are assets, dividends, and expenses. Okay, so there is no other normal balances accounts. So A is not because assets, expenses, revenue is not. That's why A is incorrect. B, assets, expenses, and equity. Equity is not. Incorrect. So C is assets, liabilities is not. So the only correct is letter D. Question 11. As president and sole stockholder, Kate Brown engaged in the following activities in establishing her salon. She opened a bank account in the name of the company and deposited 20,000 of her own money in this account in exchange for shares of common stock. How to record it? So the company that she owns will receive cash, so that is increase, that is debit 20,000. And in return, the company gives her certificate of common stock, and that is credit because common stock is a stockholders equity account. It increased, so therefore it is credit. Okay, so that's how we record it in our journal. Question 11. As president and sole stockholder, Kate Brown engaged in the following activities in establishing her salon. She purchased equipment on behalf of the company, on account to be paid for 30 days, on account meaning by loan, for a total cost of 4,800. The journal entry should be like this. Equipment increased because she bought it. So equipment is an asset, it increased, this is debit. Then accounts payable, because it is not paid by cash, but is through loan, so accounts payable increase, that is credit. Okay, so question 13. As president and stockholder, Kate Brown engaged in the following activities in establishing her salon. She interviewed 3 persons for the position of hair stylist. Prepare a journal. There's no journal entry because this is not a transaction. This is a company activity that is classified as non-transaction because there is no exchange of money. There's no trade. There's no transaction involved. There's no economic activity in here. So no entry in our journal record. Question 14. Posting transfers journal entries to ledger accounts. The answer is letter D. That is the definition of posting. You are recording into the ledger accounts. What is your reference? Reference is journal entry. From the journal entry, you are going to record it into a ledger accounts. Question 15. Kate Brown recorded the following transactions in the general journal during the month of March. Post these entries to the cash account. So the ledger is titled or named as cash. So cash is a ledger account, and we are going to post the transaction from the journal, which looks like this: March 4, March 15, and March 19. So there are 3 transaction entries. So which are the cash? So there are cash debit on March 4, cash credit on March 15, and cash credit on March 19. Okay, so there are 3 entries here. Okay, so why we have March 1? There's no March 1, 600. That is from other examples. So the only entries is March 4, which is 2,280. March 15 is 400, and March 19, 92. So there's no record of March 1. So probably this is from previous example. So take out that entry 600. The correct answer should be 2,388 minus 600. So that is what? 1,788. The correct answer is 1,788. Question 16. The time period assumption states that time period assumption, meaning period has a beginning and has an end. It's a one cycle process, no? So beginning and an end. So A, revenue should be recognized in the accounting period in which it is earned. So it's not correct. B, expenses should be matched with revenues. That is not a concept in accounting. C, economic life of a business can be divided into so this is the definition of time period assumption. So the economic life is finite. It is not infinite. Okay. So the fiscal year should correspond to. It's not always. Sometimes you can do it, but it's not required. It's not required to have fiscal year and calendar year to be equal with each other. Question 17. One of the following statements about accrual basis of accounting is false. Accrual. So the answer here is letter D. Let's read. Revenue is recorded only when cash is received, and expenses are recorded only when cash is paid. That is not accrual. So we have to record immediately as soon as the transaction happens, and just accrued whenever there's a payment. But this is not the case, no? Recorded only revenues, no, it's not recorded only. When expenses and cash is received. So this is not the accrual basis of accounting. Accrual basis of accounting is in accordance with GAAP, yes. And letter B, revenue is recognized in the period in which the performance obligation is satisfied. So if you are being paid but you have yet to perform the service, okay, so it's not yet revenue. So this is correct. So events that change a company's financial statement are recorded in periods in which the events occur. So this is correct. So therefore, the wrong one is letter D. Question 18. Adjusting entries are made to ensure that A, expenses are recognized in the period in which they are incurred. So that is correct. Revenues are recorded in the period in which services are performed. So expenses incurred, recognized. Services performed, recognized. Because you are earning that revenue because you already performed. Okay. Similar to with expenses. C. Balance sheet and income statement accounts have correct balances at the end of an accounting period. So it must be the case. And therefore, the answer is all of the above. Question 19. A concept is provided in the left column with a description of the concept in the right column. So, what about accrual basis accounting? Which one is it? Accrual basis accounting, the answer is F. Companies record transaction in the period in which the event occurred. So, that is accrual basis accounting concept. When you perform the services, so that is event being core. Okay. What about uh, calendar year, which is the match description of this concept? Calendar year, the answer is E. The accounting time period that starts on January 1 and ends on December 31. That is the calendar year. Accounting time period. Okay? Calendar year. You can have uh, uh, can you have any other answer? January 1 to December 31, of course, that is a calendar year. Concept is time period assumption. What is its possible description? Let's take a look. The answer is C. Accountants divide the economic life of a business into artificial time periods. So, economic life. Artificial time period, okay. And what do you call that uh, time period? Accounting period. Could be monthly, could be quarterly, could be yearly. So that is the um, artificial time periods. Okay. Time period assumption. What about the concept expense recognition principle? What is its possible description? The answer is B. Efforts or expenses should be matched with results, revenues. Okay. Expense recognition principle. Okay. So this principle is very practical to the business because you make an expenditure because you want the revenue. Okay, you are making the expenditure. You spend something because you want the revenue. Okay, so that is the concept expense recognition principle that matches expenses with revenues. Question 23. The ledger of Hammond Incorporated on March 31, 2019 includes the selected accounts before the entries are prepared. Tab is a given. Prepare the journal adjusting entries for the month of March. So what is the transaction? Insurance expires at the rate of $100 per month. So we have a prepaid insurance for probably 1 year and only $100 per month. So we have what? Insurance expense 100 for this month. Prepaid insurance, of course, credited to the prepaid insurance account, which currently have 3,600. So it will what? So be subtracted. So the remaining prepaid insurance should be what? 3,500. Question 24. The ledger of Malmon Incorporated on March 31, 2019 includes the selected accounts for adjusting entries are prepared. So we have the following and we are going to prepare the journal adjusting entries. Transaction, supplies on hand, total 800. Supplies on hand, you will use it because it supplies 1 month use. How much? Okay. And the supplies on hand is 800. How much is the previous supply? 2,800. Therefore, how much was used in that month? So 2,800 is written there, and supplies on hand is only 800. So therefore, we use 2,000 amount of supplies for that month. Okay, so we have supplies expense on our journal as debit 2,000, supplies 2,000, credit. Okay. Question 25. The ledger of Malmon Incorporated on March 31 includes these selected accounts. We are going to prepare the journal adjusting entries for the month of March. What is the transaction? The equipment depreciates $200 a month. Equipment depreciation is a real thing. So, we use the equipment for 1 month. $200 have to be lessened to the current amount of the equipment. So, the current amount is 25,000. So, less 200. So, the current amount for the next accounting period is 24,800. But how do we enter the recording to the journal? Depreciation expense, then 200 debit, accumulated depreciation of equipment 200. So from depreciation, we will put that as an expenditure of 200 for the month. Okay, question 26. The ledger of Hammond Incorporated on March 31, 2019 includes the selected accounts before adjusting entries are prepared. So prepare the journal adjusting entries for the month of March. What is the transaction? During March, services were performed for 4,000 of the unearned service revenue. Okay? We have an unearned service revenue amounting to 9,200. But we already performed this month 4,000. So we have to recognize the conversion of that unearned service revenue to service revenue. Okay? So service revenue credit 4,000. Unearned service revenue debit 4,000. So question 27. Problem. In October, Pioneer Advertising Incorporated performed services worth 200 that were not billed to clients in October. Prepare the journal adjusting entries for the month of October. October 31. Always, because we are adjusting the entries, that is the last day of the accounting period. So your adjusting entries should look like that. No? October 31. Accounts receivable 200. Service revenue 200. Okay. Question 28. Microcomputer services began operations on August 1. At the end of August, management prepares monthly financial statement. It is monthly. And what is the transaction? August 31, the company owed its employees 800 in salaries and wages that will be paid on the following day. Prepare the adjusting entries needed at August 31. So salaries and wages expense and accounts salaries and wages payable. So we have an expense account and we have an liabilities account. We are liable for the payment of employees, salaries, and wages amounting to 800. Question 29. Microcomputer services began operation August 1 and at end of August, management prepares monthly financial statement. Okay, what is the transaction? On August 1, company borrowed 30,000 from a local bank on a 15-year mortgage. The annual interest rate is 10%. So, how do we do that? So, monthly financial statement. So, annual interest rate, 10%. So, that is annual. How about month? So, divide by 12, no? So, how much is the yearly? The yearly is 3,000. So, divide by 3,000 divided by 12. So, that is 250 per month. Okay? So, to divide 3,000 by 12, that is 250. Okay? So, therefore, interest expense, 250 debit, interest payable, 250 credit. So, we have following journal entry as adjusting entries. Question 30. Microcomputer services began operation on August 1. At the end of August, management prepares monthly financial statement. The transaction is revenue for services performed but unrecorded for August. Total 1,100. Okay. We already performed but unrecorded. So prepare adjusting entries. So that is already accounts receivable because it is already performed. So service revenue 1,100. It's not yet recorded and collected. So accounts receivable. Debit. Okay. Question 31. Which of the following statements is incorrect concerning adjusted trial balance? Incorrect. Which is incorrect? An adjusted trial balance, letter A, proves the equality of the total debit balances and the total credit balances in the ledger after all adjustments are made. Okay, that is good. Letter B, adjusted trial balance provides a primary basis for the preparation of finance. That is correct. And letter D, the adjusted trial balance is prepared after the adjusting entries have been journalized and posted. That is correct. What about letter C? The adjusted trial balance lists the account balances segregated by assets and so. What about? Oh, this is not accurate. No, that's not correct. The answer is letter C.